Hi, everybody. Mike here from Eagle Home Financial. Today, I thought I would go over the mortgage application process and included in that a pre-approval process. So when you call a mortgage broker, a loan officer, and give them your information, this is what's happening in the background. So this video, instead of just going over the cliff notes and giving you a brief overview of some things to expect, I thought I would really get into it a little bit and do a little bit of a longer version of this so that for those of you out there, my engineers and my detail-oriented people, if you really want to look at it and see what goes into it, we can kind of take a deep dive here and that way you have the ins and outs and you know what's going on when you call somebody, when you call me to get a pre-approval. Now, there's a million different scenarios out there, so I'm just going to go over one smooth looking example and then we'll go from there. So this video would be good for newer loan officers as well, just kind of getting a brief overview of the loan application and the pre-approval process. So I'm going to share my screen here. And actually, I'll bring up so essentially when we collect your information, what we're doing is initially we're filling out what's called a uniform residential loan application. In the business, we call this the 1003. So it's it's really all of your information, and we fill this out in our point of sale system. Here at Eagle Home Financial, we use a software called Arrive, where we plug in a lot of this info plus some other details that we collect along the way. So I'm actually going to go through this and fill in some details with you, and you can kind of learn about this process. And afterwards, if you have any questions or are wondering about some things, feel free to give me a call. I'm happy to answer any questions. So like I said, this is just a sample. I have no information in here yet, and I'm just going to plug in some made up information on kind of a standard loan, so you guys can see the process. So purchase price, let's say somebody's looking for a $300,000 loan. They're going to do, let's just say they're going to do a 5% down payment. That gives us a base loan amount of $285,000, or what's called a loan to value ratio of 95%. I'm going to jump over here to this box right here. This is the estimated monthly payment category. Right now, it's just including what a monthly payment would be for a $285,000 loan amount, but I don't have the interest rate in here, so it's just making that number up right now. On a $300,000 house, you could expect to pay mortgage insurance somewhere between $75 and $120 a month. So we'll just put in $100. Remember, homeowner's insurance is something that you shop around for yourself. Just like when you get a car, you shop around, you get your own homeowner's insurance, but you are required to get homeowner's insurance when you buy a house, and you pay for that premium at closing. You can pay for it outside of the closing, but 99% of the time you're going to pay for the first year's premium at the closing. So it's a part of your closing costs. After that, so property taxes, $300,000 house, we'll say, we're somewhere in the greater Detroit area, and just put in an estimated, we'll say $350 a month. And so it's calculating our monthly payment. The next category here is the mortgage insurance. That will get automatically put into the software once I price this loan out with different lending companies. And so I'll hold off on that. We'll go with a standard conventional loan on this one, amortization type, fixed 30 years. We'll just make up a 5% interest rate for now. Some of this other stuff we don't have to worry about, at least especially for this video. I'm just trying to give a general overview. So the house, we don't have a house yet, so we're going to do to be determined. This is going to be, let's just say, in Plymouth, Michigan. Whoops. Plymouth. Where are we? Michigan. 48170 in the United States. Oh, well, no, that's not country, that's county. We are in Wayne County. There we go. And most of these categories don't matter. Don't worry about that. I'm just kind of making stuff up as we go along. Here's where I enter in the title information. So if you're going to own the house on your own, joint tenants, if you're married, whatever works, and then put the name of the new home buyer in that category. We're going to save that. And then next we are going to enter in the borrower information. So I'm just making stuff up here, but we'd enter in. So when you go to get pre-approved, you need to or the loan officer working with you or myself, we're going to need to get a credit report for you. And because of that, we need to grab your social security number and your date of birth. And then enter in some other information along the way. Just some made up contact information, current address. Just make something up. Okay. You need at least a 2-year housing history. I'm just going to put 2 years in here. If you have lived in your house or apartment, wherever you are, for less than 2 years, the loan officer will have to grab a previous address for you and enter that in there. And then military info, if you've been in the military or are currently active, we select it here. And then some things about your past that we have to go through. So are you going to occupy this house as your primary residence? Yes. Have you owned a property recently? No. I'm not going to go through each one of these, but we basically have to make sure that there's nothing in your past that's going to inhibit you from owning or qualifying for a mortgage. These are things like, you know, bankruptcies, foreclosures, outstanding judgments against you, if you've been delinquent on certain things. So you basically go through these one by one. If you're filling out the application online, you can actually fill these in yourself. If we're on the phone and I'm filling the application out for you, I'll just grab this information over the phone. This one gets some people sometimes. We do have to collect demographic information for a mortgage loan approval. This is not so that we can discriminate against you. This is so that there are checks and balances to make sure that we are not discriminating in the business. So as we fill this information out, it goes into a database, and then if there's some type of trend of where loans seem to be throwing through or falling through or not getting improved or whatever based on us, and it's happening for a certain ethnicity or gender or whatever it is, the powers that be can go in there and say, hey, it looks like there might be a little discrimination going on here. That's why this section is important, so that it takes that element away as much as possible so that you can't be discriminated against. Then we also have to enter in how this information was gathered, whether it was face-to-face, over the internet, on the phone. And then once we've got all of that information, I'm not filling everything out, obviously. We'll go to the next section. This is your financial information. So yes, we get to get into the nitty-gritty. We got to get some information that you don't just hand out to everybody. Monthly income. Now, I'll just throw something in here so that we can, I'll show you why in just a minute. Oh, so we'll just make some stuff up here. I'll make up a number and start date. So for employment, you need a 2-year history. And so if you haven't had your current job for more than a year, then you need to supply a 2-year history if you've had multiple jobs over that time. If you haven't had a job, if you were unemployed, they might, for some loans, you might go a little bit further past 2 years just so that you can show 2 years of employment. or if you're a student, we'll have to enter that information in as well and put together a 2-year history. And for those, a lot of times, just so you know, if you were a student up until a year ago and then got a job, or right up until now and you just accepted a job offer, you're going to need your school transcripts, just to prove that you were in school. Let's say you make $7,500 a month. And so this, I'm going to do base income. There's salary, hourly, and then all different types of income. So military, alimony, disability, Social Security, self-employment, VA compensation, retirement. There's just every different type of income possible, and a lot of them are calculated differently. So that's really important for me as a loan officer to know when I'm filling this information out of how you get paid. And so I'll save that information. And then assets, we need to know how much you're working with. So another personal bit of information, how much do you have saved up for down payment and closing costs? So this actually, I think our down payment is about that much. So we'll just make up that you've saved 30,000, make up some numbers, just so that we can calculate this into our debt to income ratio and everything. Liabilities, so this is going to get automatically populated when we grab a credit report. And so this one, we can also just enter in some debts so that we can see some monthly payments on the credit report here. I'll just put the basic main information. That way I can show you some different things when we're looking at the debt to income ratio. We're gonna do, lease. Let's say 15,000 left on the lease and making $400 a month payments. Okay, so I'll just leave it at that. So we've got a credit card that you're paying $65 a month on, and a car loan or car lease paying $400 a month on. And here would be if you currently own a home, we'll put that real estate owned in there. And then we are going to go to products and pricing and price out your loan at some different lending companies. I've got a few pre-programmed in here already, and we can price out, find some best pricing, or this one prices out a few different lending companies so I can see what interest rates they're offering for this specific loan, and I'll apply that to this current loan right here. So now some things are going to start to change a little bit. Don't worry about all this stuff. I'm going to go through it pretty quickly, but when you're closing, most all lending companies charge an underwriting fee somewhere between $1,000 and $1,100 a month, so usually for a wholesale lender. So this one's right in the middle. There's usually a processing fee, an appraisal, credit report, some different certifications for taxes, flood, all that kind of stuff, title fees. So there's always a closing fee, typically a document prep fee and a wire fee. They may not be these dollar amounts, but they'll be pretty close to what you're estimated at. And then you always get a lender's title insurance. So these are pretty standard fees for a title company, and the title insurance is always it's a requirement. You can't get out of it, and you have to get it to protect actually the lending company, just in case there's some issues that come up on the title work after you close. That way they are protected. And then at closing, you always pay your full year's homeowner's insurance. So at $100 a month that I put in, that's $1,200 for the whole year. That's part of your closing costs. Tax prorations, these are taxes that the seller has paid. And from the day that you move into the house until the next day that the tax bill becomes due, they've paid those taxes already, because in the state of Michigan, these taxes, or for most places in the state of Michigan, the taxes are paid up front. And so it doesn't make sense for the seller to pay taxes for the time that you live in the house. So from the day that you move in, or the day, I'm sorry, that you close, until the day that the next tax bill is due, you have to essentially pay back the seller for those taxes. And then so you also pay an interest per day from the day that you close until the day that uh, or the end of the month. So you just pay, tax or interest per day. Then the next section is the escrow account. If it's your first home, or you're getting an FHA mortgage, there's a few other ones where you have to get an escrow account. If you've previously owned a home, you can waive the escrow account, but that means then you have to pay your taxes and your insurance on your own when those bills become due. With an escrow account, they get paid. You pay a monthly fee in your monthly mortgage payment, and it gets paid by the servicer of your loan whenever those bills become due. And then the property taxes. So you'll have to have enough money for taxes and insurance in your escrow account by the time that bill becomes due. And so they put that into the escrow account at closing. And then as you make your monthly payments, by the time that bill's due, there's enough in the escrow account to pay that. Most real estate companies charge a transaction fee, or a real estate compliance fee. Those are all around $395, $495, somewhere in that range. So right here is the breakdown of the total closing costs, $11,328. So, a lot of people think, whoa, that's a lot more of closing costs than I initially anticipated. But in reality, a lot of it is going to be the taxes and insurance and things that aren't necessarily what we consider the closing costs in the business, but they all add up and are seen, down here as one number. And then the down payment, and then the total closing costs of 26,000 and some change there. So once that's all put together, then we have to run what's called the automated underwriting system. And I'm getting some errors here because I didn't enter in all of the information or grab a credit report. But the automated underwriting system is a system through Fannie Mae and Freddie Mac that basically drags all of your information through the mud, scrubs it up against all of the guidelines, and checks to make sure that you're approved for the loan. Because you can see up here, one of the main things is the debt to income ratio. So I'll go back to the borrower's income right here, $7,500 a month. So when you're getting a standard conventional loan, you can typically use somewhere around 45% of your income towards a mortgage. But out of that 45%, so half of this $7,500, out of that comes your $400 a month car lease and $65 a month payment on your credit card. And then whatever the monthly payment was $2,114 on your mortgage. So that is it's coming out to 34% debt to income ratio. So say, for example, we had a borrower call us, and their monthly income is $4,000. Let's see what happens to our debt to income ratio. All of a sudden, we're at 64%. So they would either need to show more income, take on a co-borrower, or pay off some debts. So if they were to return this lease, you can't just return a lease, because then the lender is going to wonder, well, what are you doing for a car then? But we'll just say, for example, that this debt is gone. Now we're down to 54%, and we'll be paid off. We'll just omit this credit card. We're getting a little bit better. And then I'm not going to enter in information for a co-borrower, but let's just say this person is also, we'll just say that they are retired veteran. And they're collecting $3,000 a month from the VA in their retirement, and then boom, all of a sudden we're back in a green zone here, in a good place. But all this is going to get double checked through that automated underwriting system. So uh, with this, a lot of times we have to verify information as well. And so when we say, this is your monthly income, well, that's great. That's what it is, and that's what it is, and I believe you that's what it is. An underwriter is going to have to see some documentation. So we're going to have to grab pay stubs. If it's a VA income or disability or Social Security, we're going to have to see that award letter. They typically issue it once a year, and then we can verify income that way. And the same thing with all of this stuff with with the assets. You can say that you've got 30,000 in your bank account, but in reality, we got to see that. The underwriter has to see that before they can say, okay, this they've got sufficient funds to close, because we don't want to get all the way to the closing and then find out that that money's not there. And so we'll need a bank statement for that. For a lot of loans these days, you can use gift funds, and there's other ways to put things together for the cash to close. And so that's just another thing that we have to verify. So all of this, everybody's situation is different, and that's why we put the information together. And that's one of the really important reasons to work with a mortgage broker rather than a bank or a credit union or even one of those multi-billion-dollar companies that you see giving advertisements and commercials and sponsoring every sporting event under the sun. They don't really care. I mean, and they don't have all of this information. And when you work with a mortgage broker like myself, we're going to go through this stuff together, and I am going to piece it all together. And so when we talk on the phone, or you can fill this information out yourself as well, we have an online application, and but I'll comb through it. I'll make sure everything's entered correctly. And then we go back and forth. If something's not quite right, if you can't quite afford what you're looking for, or something isn't working correctly, that's what we do for a living, and that's what we're here. And the nice thing about a mortgage broker like myself is you work with us from the time of this application, or when you're trying to get a pre-approval, all the way up until the closing table. And one more note on the pre-approvals is, in today's market, when you're out there shopping for a house, you really want to make sure that you have your pre-approval ready to go, because you don't want to assume that you qualify, and you don't want to assume that everything's all set to go, because when you put in an offer on a house, a couple things are going to come up. One is the listing agent or the sellers, they're going to want to know that you qualify for a loan for this house. And so if you submit an offer that doesn't come along with a pre-approval letter, they're going to ask to see the pre-approval letter. And if there isn't one, then they probably won't consider it, because they have 10 other offers on the house that you're looking at. Why would they accept one where they have no idea whether or not you qualify for the loan? So that's one good reason to get it done in advance and make sure that you're all set to go. You've got that letter, and it can get submitted with your purchase agreement. The other reason is, a lot of times things can come up, whether it's with income, with debts, with your credit report, that you're not aware of. And this is a good way to vet it out. So I always tell people, if you're going to start looking for a home in 3 to 6 months or something like that, start getting the pre-approval put together, so that just in case something comes up in any of those things, you have time to sort it out before you get to the moment where you find a house that you want to put an offer in on. I've had people with collection accounts, for example, that they didn't know about, that hurt their credit and made it so that they didn't qualify for a loan. And it gave us enough time. It gave them enough time to make the phone calls that they needed to set up a payment plan, if that's what the situation was, and get their credit back into a little bit of a better spot before they're actually going to buy a home. So the pre-approval letters are very important. And yeah, it's very easy to do. I know this sounded like a lot of information, but this is what I do every day for a living, and know my way inside and out. So, please give me a call. Let's get you situated, and we'll get you into a house. So thanks for watching the video. If you guys have any questions or you want me to cover any topics, please feel free to leave a comment down below the video, or DM me, shoot me a message, give me a call. I'm happy. I'm here to help you with any of your mortgage needs. All right, guys, have a great day. Thanks. Mike at You Go Home Financial.